Earnings season is nearing a close, but company trading updates will offer a look into the performance of various industries, from fashion to travel to the tobacco industry. We'll explore it all on today's episode of Market Insight. I'm your host, Leah Mishkin, and joining us to help us get a snapshot of what we can expect this week is XTB Research Director Kathleen Brooks. Kathleen, good to have you back. So let's start with a big one. Inditex, the world's biggest fast fashion retailer, owner of Zara, reports Q1 results on Wednesday. Barclays forecasts Inditex sales growth to fall and gross margin to improve. If that holds, what does it tell us about the industry?
Well, it's a really interesting one because essentially we are expecting sales growth of just over 9%. That would be the first time that it's in single digits since 2019. But on the other hand, as you said, Barclays and other analysts are forecasting stronger profit margins. And that's due to lower freight costs, lower input costs, because inflation has been coming down. So profits could potentially be protected here. And we're not expecting any change in guidance. But it certainly does tell us that the consumer is weakening because Inditex and Zara in particular is such a global brand. It's really showing that those higher interest rates, they're starting to bite, they're starting to affect consumer patterns. And that huge amount of disposable income that we saw and that spending on things like Zara clothes, that could potentially be shifting and certainly downgrading. And that could hit Inditex, maybe not now, but definitely down the line.
And next up tomorrow, a trading statement from WH Smith. Last month, the company was trading at its lowest level in years. Some believe the retailer is seen as a bargain FTSE stock for those looking to invest. Do you agree?
Well, I mean, if you look at the margins of what is, how to value a stock, then you would say, yes, absolutely. The metrics do make it look like an absolute bargain of the FTSE 250. It's got a price to earnings ratio of less than 1. However, there is a reason for that. And it's been a really, really long road to recovery for WH Smith. We're still expecting that recovery. The share price is down 30% in the past year. So we're looking for some good news, maybe on the travel sector. We've still got that travel boom going on. Can they really capitalize on that, on people going to their stores when they're going through airports or railway stations, for example? The other thing that we're going to be looking out for is, are they expanding overseas? Right now, half of their stores are in the UK. What about the US? Are they expanding over there? I think if they are, then we could see some good news and actually some bargain hunting. And WH Smith has got to be on that list if you are looking for a good bargain of a UK stock.
And we're also going to get full year results for the discount chain B&M, who has 700 plus stores across the UK. What can we expect?
So, yeah, I mean, they're looking at revenues of just under £6 billion. So that would be about an increase of 8% over the year. So that's pretty solid. And it's reflected in the share price. It has been rising so far this year. A bit slower than the overall market, though. But I think the thing is, are they able to capitalize on the demise of their former rival, Wilko? So we're going to be looking at what is the market share? Are we going to see any potential uplift in growth? I think there's an expectation there that they might do better than what some analysts expect. And if that happens, then we could see an uplift in the share price, but there's a lot obviously priced in already. So if they miss the mark and they haven't really been able to capitalize on the demise of Wilko, then there could be a little bit of selling in B&M tomorrow.
And last up for our wrap-up, British American Tobacco. The company expects half-year revenue and adjusted profit from operations to fall by low single digits. How good have they been to moving to a vape market?
Yeah, so they reported results today, and actually their share price is down by 1.8%, and it's one of the weaker performers in the FTSE 100 today. And that is largely because they are very much looking to growth in the second half of the year. So they didn't change their guidance for this year, but they are looking for it to be really weighted towards the second half. So there's an awful lot for them to do in the last 6 months. I think there was also a bit of disappointment when it came to buybacks. They announced a £700 million buyback for this year, $900 million for next year. However, the thing to note is that a lot of companies are buying back stocks at the moment, and they're doing it in the billions, not in the millions. So I think some people thought that there would be a little bit more, largely because they've got quite a lot of free cash flow on the balance sheet. So they could have been a bit more generous with the buyback, and they are getting punished for that today.
XTB Research Director Kathleen Brooks, many thanks for your thoughts as always. That's Market Insights. Read more about these stories and more, head over to Reuters.com.